Okay, everybody, let's get going. Excited to be here again. David Arbit, Research Director with the Minneapolis Area Realtors. Let's see who we got. Amy's online today. We got Nan. We got Sarah's iPad. Always good to see Sarah's iPad. Thanks, guys, so much for being with us today. Got a good session for you. I do want to dive into InfoSparks a bit. It seems like we never have a chance to get into it because there's just so much other good stuff to cover. But I do want to spend some time in InfoSparks today. And we're going to do a little bit of an annual recap. I already see some names that I know weren't here for that, for our January webinar where we did kind of a true annual recap. But I just want to blow through some of the slides to give a sense for what's happened, how the year sort of wrapped up, because I know not all of you have had a chance to kind of see that. So that'll be pretty quick, just know, but that is coming. We will also do some January numbers. As most of you know, things looked a little different in the first half of last year than it did in the second half. So we are going to look at that a little bit, and I think you guys will really enjoy this. So thanks again for being here. Let's get my screen shared. Let's check chat. Okay, looking good. Let me have chat up for us just so I can be aware of any questions you guys have. And okay, looking good. So thanks again for being here, guys. Excited to be here and excited to geek out on some market stats with you. All right. So a little bit of text to start us off with here. I don't always start off with this much text, but I am today. And I just want to give a sense of kind of what's happening, not from our point of view, but more from a national point of view. And these guys are pretty sharp people, all of them. I've met, I think, most of them. And they really are, they're sharp folks who don't beat around the bush and who really kind of understand what's going on. So just real quick from HousingWire, the red hot housing market of the past 2.5 years was characterized by sub 3% rates, fast-paced bidding wars, and record low inventory. More recently, market conditions have more or less done an about face. Now is the opportunity for everyone to become re-educated about what a typical housing market actually looks like, right? Okay, let's make sure I'm out of my Teams and email so I don't get any funny chats. Yeah, what a more typical market kind of looks like. So while 2022 may be remembered as a year of volatility, 23 will likely be a year of long lost normalcy, sort of returning to the frenzied market that we've seen lately. Mortgage rates, expected to stabilize while home sales and prices moderate a bit after the recent highs. Danielle Hale, really sharp gal who I've met and I really admire. Buyers will not face the extreme competition that was once commonplace over the last few years. Here's Lauren, someone I've met many times and really respect and try to emulate even. After a big boom over the past 2 years, there will essentially be no change, at least at the national level. So half of the country may experience small price gains while the other half may see slight declines. So this is very different than what we saw in 2006, 7, 8, well, 2007, 8, 9, where all markets were really kind of softening because of the oversupply. And then with what happened in the economy, layoffs and income loss, every market nationwide, every local market basically struggled and really faced challenges. That's not the case this time around. We'll actually talk more about that, but things are so different by parts of the country, by city, so on and so forth. So, and then finally, Mark Fleming from First American title, housing market once adjusted to the new normal of higher rates will benefit from continued strong demographic driven demand relative to an overall long run shortage of supply. So guys, this hasn't changed. If anything, it's gotten worse. So, builders just aren't building. Sellers aren't really listing because they feel wed to their 3% interest rate. So there's a lot of opportunities for spokes in the wrenches in the spokes, if you will. But, what really underpins housing markets, yes, rates, but it's really demographics and income. Do we have this generation of millennials who are aging into their prime home ownership years? Yes, we do. We also have some downsizing boomers who are looking at, maybe a 1,600 square foot townhouse over a 3,500 square foot single family home, that was meant to raise their 2 or 3 kids in. The other thing, new household formation. So are we forming households or are we not? So those are sort of some of the underpinnings of what moves markets. Let's jump right in, guys. New listings, January. Let me get my laser. I don't want to get too crazy here with my laser. Come on, laser. Here we go. All right, laser. So January new listings, guys, metro-wide, you can really see our peak for seller activity, at least for January, well, pretty much for every month, in 07 there. Listen, we've got a third as many listings coming online than we did kind of at the peak, about a third. So that's a pretty compelling data point there. You could kind of see us flattening out a bit, guys. Look at this, 1, 2, 3, 4, 5, 6, 7 years of 4,000 to 4,500, kind of right around that 42, 4,300 mark. So we had kind of flattened out a bit as seller activity stabilized. And then over the last 2 or 3 years, of course, at least in January, we saw fewer people listing. In some months of 2020, 21, and 22, obviously we did see a lot more listing as folks were moving, right? Folks were getting the next home. But for January anyway, we definitely see a slowdown. This is the lowest count for new listings for any January in at least 20, 21 years. I'm comfortable saying probably significantly further back, but maybe not that much farther back. I'd be comfortable saying at least since 2000, but hard to say in the, go as far back as the mid 90s. That's a little hard to say, but really looking for a little bit of stabilization here, because if rates, I should say, if and when rates do touch 5 or even 4.9%, you're going to have buyers back out on the streets and you're not going to have the product to sell them. So still very much a concern. January pendings. So signed contracts, accepted offers, executed purchase agreements, however we want to think about this. Pretty clear to see our pie in the sky back here. Then enter the housing crash and mortgage and foreclosure crisis and the Great Recession, and you guys can see what happened then. Pendings, right? Nice recovery. Can definitely see 2021, that 7-8% increase, definitely COVID, in part COVID driven. And then you start to see sales kind of come back down to maybe where they were before the COVID frenzy. And now you see, obviously, with what's happened with rates, you see buyers pulling back down about 20% for January. Now, looks extreme. It is a pretty big move. However, in the fourth quarter of last year, we saw a couple months of -30, -40%, a 30 or 40% decline in signed contracts in pending sales. So hopefully a sign that some of the worst declines could be behind us, but that doesn't mean we'll magically be positive, all of a sudden. So give this one some time to catch up a bit. The hope is that the worst of the declines are probably, the data could suggest that the worst are kind of behind us. All right, closings. Guys, perfect example. There's your down 32% for closings, but pending's only down 19%. Why does this matter? Pending sales have always been and always will be a leading indicator for closings. So some call it the thing before the thing. Before you close, right, you gotta write an offer. You gotta have an accepted offer. So if you want to look at what's going to close tomorrow, look at what's gone under contract today. And so sure enough, our leading indicator is showing, okay, demand down more like 19%, not quite 32%. Now, closings, what? Closings reflect contracts entered into when? 30 to 60 days, right? 30, 45, 60 days ago. 30-day close, or, sometimes 45 or longer, or 60. And so this is old data. These are homes that closed in January that probably had signed contracts in November or December. So here again, I don't mean to beat the dead horse too much, but here again, pendings are a better leading indicator. It kind of talks about what's happening now, or at least what happened last month. Closings really tell us kind of what happened in November and December, maybe a little bit early Jan. So take that for what it's worth. CDOM, cumulative days on market just for January. This is a median. Some of our reports have average, which is always a little bit different. Can really see the COVID skew, the COVID impact here. 45, 44, 43 days, down to 2 years of 22, I should say 2 Januaries of 22 days on market, and now up, yes, almost 100%, right? 22 to 44 would be doubling, so that's almost 100%. But it's only to 43 days on market, which is just about even with pre-COVID, right? So Jan of 2020, by a couple months, was sort of a pre-COVID period. But really, of the 2018 and 2019 of the kind of preceding years, you guys can see we're pretty flat, we're pretty even. So sometimes I say this, and I'll say it again. It doesn't matter if you're a CNN person or a Fox News person or somewhere in the middle or elsewhere on the media spectrum. You may hear people say market times have almost doubled, and that's scary, right? And that gets viewers and readers, and that gets subscribers, because fear and greed motivate people, right? It makes us do things. So you might hear this 100%, and you might just see this 22 to 43. Guys, that leaves out really an important part of the picture, and it just doesn't bring in this context that actually, yes, it's up, but this was the anomaly, right? The 22s are the exception to the rule, right? This is kind of the trend. This is an exception. This is an anomaly. So to look at this and say, oh, well, 22 to almost 44, market times doubled. It's taking sellers twice as long to get accepted offers, or to get, offers that they're happy with, to sign contracts on those listings. But again, that leaves out that it's really just even with pre-COVID levels, and probably closer to normalcy than these 2 years. So again, don't be fooled by someone trying to convince you that this is some new trend, right? Versus just kind of getting back to where we were after, I'm not going to say the pandemic has ended, but the worst of it may have subsided a little bit. I guess I'll say that. January original list price. So sellers list their homes at a value, and then buyers, well, first of all, they write offers on those list prices. Second of all, they can also choose, they can pick and choose. Maybe I look at a 250 or a 280 home over the 340 or 379.9, right? So sellers listed their homes for about 10% more than they did the January prior. So 360 versus 395, almost 400K, guys, getting pretty close. I would expect that this year. It'll probably be in, spring, summer months. So probably, April, May, June. But list price is up almost 10%. Zillow said my house is worth 400,000. I'll give you 150. CMA stands for Country Music Awards. No, comparative market analysis. But look at the sales side, you guys. Look at the sales side. So median sales price, forget list price, sales price only up about 2.5, 2 3/4 to 342. So, more recently, you can see some, stronger price growth. Obviously, here's 10, almost 11. Here's 11.5. Did have a 4.25 kind of early in 2020, kind of before COVID really impacted us. So, this 2.7 is actually the lowest growth since we had a decline in 2012, right? So this is the slowest rate of price growth in over 10 years for a January, right? I would expect that to continue for the year. Here's the kicker, though. You'll notice prices still positive, right? Home prices still rising, but at a reduced pace, at a decelerated pace. All right, I love this one, guys. What a story it tells. Forget looking at price. Let's look at change in price. So instead of from 0 up to 400,000, now we've got 0% change, or plus 10% change, or minus 10% change in the median sales price. So what are people buying that median priced home? What's happening to it year over year? Well, going back to the bubble years, we had some 9%ers, right? Things really kind of slowing down before going negative. We headed into our crash. You guys remember that little tax credit period? Sometimes I like to reference that because look at the blue, you guys, look at what it did. Without that, without that government incentive, we probably would have looked more like that, right? Instead of like that. So always interesting to think about it. Although some of you might be aware we cannot relive or change the past. Check this out. As we came out of recession, saw a lot of investors and flippers and I guess good market timers who really competed with one another and drove prices up almost 18% year over year. So we really see strong growth here. Notice we've leveled out, you know, before COVID, we'll talk about that in a sec. We were kind of leveling out to what, 4 to 6, right? 4 to 7% or something like that. We had a couple 10%ers, and also looks like a 2 or 3%er there. And then enter COVID, guys. Look at what happened in the middle of 2020. So COVID, so the lockdown orders really happened mid-March, had a little bit of a pullback in April and May, but really by June, I mean, look, right? We got to above 10% price growth and we stayed there for a while. And then we were kind of on either side of it, right? Some 8s, some 10s. Look at what's happened more recently. And let me actually zoom in for you. Look at what's happened much more recently. Peak growth during the COVID era was about 16.7, 17%. Slowed down, settled into 10%, slowed down more into 5%, and there's that 2.7 that we just saw. So price growth still positive, but definitely taking a breather and allowing incomes some time to catch up. So a little bit of catch up mode there. So I think it's probably good that there's a pause, but just be careful how you counsel your sellers. They should not be expecting, you know, their home to be worth 10, 20% more. Of course, it depends on area, property type, and everything else. PPSF, price per square foot. Listen, if we think, or excuse me, if we know that more new homes are selling, that new construction's making up a larger share of the market, well, what do we know about new homes? They tend to be 2,800 square feet, sometimes 3,000. What do we know about existing homes? Very often 1,800, 1,900, 2,000 square feet. Well, guess what, guys? Bigger homes almost always command a higher price if everything else is held equal. Quality, condition, location, bed, bath, garage, all that good stuff. So if we know that we've seen more new construction, we don't want to let that skew our price metrics higher. So what do? Let's normalize the data. Let's standardize the data for size. Let's take sold price divided by TFSF, total finished square footage. And that's how we get price per square foot. So $140 a foot down to $80 a foot, and now just at about $180 a foot. So this is January. I think I do have PPSF for the year, which I think was 190, maybe 190 or so. So guys, $200 a foot for a 2,000 square foot house, that gets us to 400K. And sure enough, what's our median? 360, 370. So we're getting close. Another thing you'll notice, once we undo the effect of the size of the homes that are skewing things, now we see an even more modest price increase, 0.8%. Also, definitely the smallest growth since a decline. So definitely leveling off a bit, but we are not seeing declines. January, percent of original list price received at sale. Some of you know that this is one of my favorites because it really speaks to sort of the power dynamics between buyers and sellers. Look, sellers didn't have a lot of pricing power here. They had to give buyers a 12% coupon, 12% off on their listing. They were desperate to get them sold, right? Market a little stronger back in 04, 05 before the crash, where sellers were getting 98%, right? 97.5%, 98% of their original list price that they received at the closing table. Tax credit, right? Interesting. This is why we kind of call some of this stuff out, you guys, because it stands out, because it's interesting. And I think it's worth kind of calling out. So flattening out a bit, up, and then flattening out a little bit. And then, golly, really clear to see the COVID signatures here, right? 99.5 and 99.6. So that was our party, and this is a little bit of our hangover. So we really had to kind of cough some of that back up, and we've settled back down to 96, which really isn't that far off from the historical trend if you sort of average them out, right? So way above average, way below average, but 96, 97 is probably about where we belong, to be honest. Guys, some homes under 200K in some parts of town could still be getting 110. Some other product, elsewhere could be getting, 80, 90%. So just know there's variability here. There's a lot of variation here. So really a pretty noticeable change from 99.6 to 96.0. Love this one. I didn't used to include this until recently, especially given what's happened over the last 6, 9, I think we can say almost 12 months now. That was percent of original. This is percent of current list price. So if you started at 400,000, but now you've reduced to 379.9, well, if you accept 379.9 out of 400, right, that's how much you accepted of your original. But if you're at 379.9 and you accept 379.9, now you've accepted 100%, right? So now you're back to 100% of your current, not of your original, but of your current list price. So look at this one, guys, 99.5. Yes, that is the lowest level, roughly back to 2018 levels, but above 2017. Notice our 2 COVID years at 100% of current. Check this one out, guys, though. 99.5, it speaks to once you're priced right, and sometimes that requires a price adjustment or reduction. Once you're priced right, sellers, you're actually going to get 99.5% once you're priced right. So what did someone say in a brokerage the other day? SSP, seller selected pricing, right? Seller selected pricing. If the seller is going to insist on being at 409.5, they're going to miss out the people who are looking up to 399.9. And, maybe your home's only worth 384.5, whatever it is, guys. So just know once you're priced right, you're still getting pretty strong offers. Inventory, January, obviously a cold month, and so less activity. 30,000 active listings in 2008. We ended last month with 5,600. 5,600 active listings or homes listed under active status. It's not a lot, folks. It's really not a lot. But it is up 15%, 15%. Let me zoom in here. So just a couple other takeaways here. And I actually think they're a couple pretty interesting observations. Yes, 15%. Sure, I guess we're off this floor. If you want, buyers can take some comfort in that, right? They do have more options. My fear is that they think, this 15%, oops. Oh no, I can't use my laser when I'm zoomed. So you guys may not be able to see this, but this 15%, well, look, guys, it's 5611 versus 5602. It's not even, yes, it's a little above 22, but it's not really above 21. And here's the real kicker. It's still well below pre-COVID levels, well below 2018, 19, and 2020. And I think that's a big message. That's a big takeaway. So again, buyers see plus 15%, and they're thinking, wow, it's a buyer's market. Look at all this new supply, right? We must be up here with all this supply. Psst. By the way, we need to be here. We need 20,000 active listings, 20,000. Why? Well, if you're selling 4,000 a month, that's 5 months of supply. If you have 20,000, right? 20,000 divided by 4,000 sales a month is 5 months of supply. That's a balanced market. 4, 5, 6 months is kind of what we're shooting for. Been hard to achieve, but that's what we're aiming for. So don't get too ahead of yourselves, buyers, in terms of kind of what you're thinking, this means. Yes, it's an increase. Yes, it's a little looser. Yes, you have more choices. You do have more options than you did the year prior. I suppose you have 9 more than you did in January of 2021. But again, 20,000 would be a balanced market where we're not favoring buyers, but we're also not favoring sellers. It's not a buyer's market or a seller's market, but a balanced market. Month supply, speaking of balanced markets, nice segue there. I did that on purpose. Here's our 4 to 5, again, 4 to 6 months of supply. You guys will see we don't spend a ton of time here. Maybe this one and this one, maybe kind of this one, almost 4 here. So, it's the pendulum, guys, right? Undersupply to oversupply, back to undersupply. We want the pendulum in the middle, but it doesn't stay in the middle. Markets don't move that way. Stock market, housing markets just don't move that way. Labor markets. So look, we were undersupplied with 3.5 months of supply, and then we blew right past balance into 9 months, and then we were sucked right back down as demand far outweighed supply, or outpaced supply, I should say. A couple of years ago, we had 9/10 of a month, 0.9 months of supply. 0.9. We now have 1.3. That is up almost 50%, right? So that is a change, and it's worth pointing out that change. What's also worth pointing out is that we are still tighter than we were in 2018, 19, and 2020. So 1.7 down to 1, down to 0.9, and now back up to 1.3. 45% increase is a pretty noticeable increase, right? It's a pretty in fact, gosh, well, just for January, that's strongest increase I show for January in the last 20 years, right? So, and this is when we really saw these changes in the market. So yes, this is a change in the market, but it's off of such a low baseline. I mean, just a ridiculously low and tight market, an undersupplied market. So, again, your buyers are going to be looking at this and say, oh my God, absorption rates are up, 50%. We can go around the metro and lowball sellers. You can, you're probably not going to have a ton of success, but you may be able to write an offer for 1 or 2 or 3% below asking versus 2, 3, or 5% above asking. But just know we are still in an undersupplied seller's market. What do we mean when we say this? So this is a little bit of an older one, guys. I like bringing it in. I know we've got some fresh faces, or at least fresh names here. Can't see any of you. So understanding month supply of inventory. It's the number of months it would take to sell off our current inventory, assuming no new supply enters the market, right? And it's really similar to an absorption rate. It's just kind of the inverse. So 5 months of supply would be a 20% absorption rate. If it takes us 5 months, that means that 20% of the inventory is absorbed in a given month. Does that make sense? So 2 months of supply, do 1 divided by 2, that's a 50% absorption rate. If your inventory lasts 2 months, or wait, sorry, wait a minute, I just confused myself. If with 2 months supply of inventory, yeah, half a month, half of your inventory is absorbed a month. So in sellers markets, we've got all these buyers, you guys, and they're all amped up, ready to write an offer on this house. They don't have many houses to write offers on, so they're all competing over this one. That's a seller's market. Low supply, high demand, sellers at an advantage, home selling quickly, and prices rising pretty quickly as well. Buyer's market. Let's contrast that. In a buyer's market, instead of the buyers competing over the house, now it's really the sellers competing for the buyers. So it's just the opposite. So these sellers basically have to out-concede or out-reduce one another in order to lure in, right, one of these buyers. You guys can see what comes along with that. Balanced market for 4 to 6, 5 to 6 months. Traditionally, you've got 4 units of supply, and they're all well matched up with 4 units of demand. All right, annual numbers. A lot of charts, guys, so I like to break it up with some pretty things. New listings, annual. We're going to blow through some of these, guys. I know some of you have seen these, but some of you haven't. It's only February. I promise you by March, I probably won't bring some of the annual charts back. We'll be looking forward a little bit. So what do we show? Down, were we 19% for January? So on the year as a whole, down more like 10%, right? A little bit more like 10%. You guys can see us flattening out after the recession, after the Great Recession, really flatlining again from what, 75 to 80, roughly kind of either side of 76 or so. And then we started losing, obviously, especially last year when folks wanted to hang on to their interest rate. But also when a lot of them had already purchased here, right? And a lot of those were first-time buyers, so they didn't have one to list. They didn't put one into inventory, but they sure sucked one out of inventory. Pendings, annual. Previous peak, 62.8. Let's look at closings for a second. Previous peak, 61, let's call it 61,200. We surpassed that at 61,300. We hit a record for sales in 2017, and then we easily hit a new record in 2020, and then another one in 2021 before we had to really pull back in the face of rising rates. So pendings, closings, pendings, closings, pendings, closings, pendings, closings. That's enough of that. So yeah, minus 20, I said that was enough of that. Minus 20.5% for signed contracts, more like down 19% for actual closings. One more note here, guys. I know I've mentioned this before. Is it really fair to compare to this period? It's probably not a good sample of what the market kind of really looks like. This is part of the COVID frenzy. So it probably makes sense to average, the 2 or 3 or even 4 years pre-COVID. That sure looks like 60,000 to me. So let's call it 60K. Well, what's 54 relative to 60? So 60 minus 10% would be 60 minus 6, which would get us to 54. So it's more like a 10% decline in demand if you compare it against more normal years, the sort of non-COVID or pre-COVID years in the BC era, the before COVID era. Ooh, pretty. Days on market, CDOM, same metric. Last one was January. This one's for the year as a whole. So, obviously, first half of the year, still pretty strong, right? Sales, still okay, up and down a little bit, but really not like what we saw in the back half of the year. So first half of the year is probably going to be kind of pushing this down a little bit. Back half of the year is really going to be skewing this up. So what did we show for market times? Was it 45%? So for the year, though, that was January. For the year, though, more like 27%. And it's still really clear here, you guys, 11 up to 14 days. Oh my God, 3 more days, still below 2020 and still notably below 2017, 18, and 19. So we went from a week and a half up to 2 weeks. And pre-COVID, we were kind of 3 day or 2 under 3 weeks, day or 2 over 3 weeks. So just keep this in context, you guys. You really can't take this stuff out of context. Some people say, David, do you really need to go back to 2003? Do you really need it? Well, I think, yeah, we kind of do. I want to show this run up in the bubble, the downturn, and then the recovery since, and kind of gives us a sense of where we are, where we were, which I think helps us understand where we might be heading. Okay, days on market. Used to spend 100 days, 99 days on market, down to 14. But yes, up 27%. Median sales price. Let's make sense of the dollars here. So there's your 362.5, up 6.5%. Not the 11.5% or the 9%, but was above the 5.5, 5.75% that we saw in 2019. PPSF, promised you I had this one. Did I say 190? I'll have to go back. I'll have to watch the tape on that one. So yeah, 185, 190, maybe I said 195. Anyway, so about 190 for the year. That's how much we're paying per square foot. I do not care if you have 1,200 of these square feet or 12,000 of these square feet. We are asking and answering the question, how much are you paying for one of those square feet? And sure enough, it's about 190. Again, 2,000 square feet. If this were 2,000 square feet would be just about 400K. I really don't love the way this metric ended up last year. Again, same thing. First half of the year, very much uplifting this metric. Second half of the year, depressing this metric. I don't think it's really representative of the year that we ended at basically 101, down from 102, right? So 2% over list price, now more like 1% over list price. versus 99%, that's 1% below list price. So not in love with this metric. Excuse me, I love the metric, not in love with how it looked last year, just because of it was a tale of two markets, right? First half and back half after rates really spiked on us. After the Fed poured cold water all over your party. All right, you got to disrupt the charts with some pretty design. You're welcome. Inflation adjusted home prices. Shall we do this one? We're going to anyway. So check this out, guys. Nominal home prices all the way back to 03. You'll see the seasonality here, right? Winter months, spring, summer, winter months, spring, summer. So you see that seasonality, and wow, you really see that seasonality, kind of during the COVID era, during the frenzy. Look at the growth here, guys. I mean, if you look at kind of peak to peak, right? Peak to peak, peak to peak. Here it's like, wow, peak to peak, and even here, peak to peak. Although also a little bit more of a come down than we have, in past years. So that's nominal home prices. Those are the home prices that they are at the time. So here we are right now, right? There's our 375, 350, there's our 362, whatever. Blue is implied home prices or real home prices. Real home prices are declining. Why? We just saw that the median price was only up 2.7. That's 3%. What's inflation? Up 6%. So plus 3% nominal minus 6% because of inflation. 3 minus 6 gets us to minus 3%. So in real terms, prices actually have softened. But in nominal terms, they haven't. But the rate of price growth has slowed, as we see. You tell me what you guys prefer. I'm going to show you the next one. It's just it's not the opposite, but it's a different methodology. So this one uses constant $2003. They start at the same time. One is not affected by inflation. Blue is not affected by inflation. Red is inflationary prices. I think I like this one better. Instead of $03, now we're in $2023. So instead of starting at the same place in $03, now we end at the same place in $2023. So basically, we're kind of inflating backwards, if you will. So in red, nominal home price, the actual home price at the time. Peak of the bubble, we were spending $230 on a home. Nowadays, more like $350, $360. But look at implied home prices. If we bought a house in today's dollars back in 2005, we would have paid about $350. Instead, we paid $230, but those were the dollars at the time. In today's dollars, inflated dollars, here's what we would be spending to buy a house then with today's money. Pretty interesting. Pretty interesting. Anyway, okay, guys, time check. Oh gosh, we're geeking out too much. Let's speed up a little bit. So guys, payments. Let's look at payments. People care about payments. In fact, it's probably top 3 things people care about when it comes to residential real estate. Everybody goes to their lender and says, I need to keep my payments below $2,500 a month. You tell me what I can afford, given my budget and debt to income ratios and credit score and all the rest. So some factoids: median family income, 111. That's the percentage of that pre-tax income we're spending on housing. That's the dollar amount to housing. I should say the dollar amount in payments on the median priced home. That's annually, and then this is yearly. Sorry, that's annually, and this is monthly, $2,300 a month. So look at the change, guys. Look at this change from, let's call it $1,800 to $2,300. So that's $500 a month. That's $6,000 a year. And it's just interest, right? So that is a challenge. That poses a challenge for folks, especially first-time buyers who didn't buy a $250,000 home 7 years ago that they're now selling for $350,000, and they can use that $100,000 as 20% down on the $500,000 home in Blaine or Lakeville, right? So they're selling St. Louis Park, Richfield, South Minneapolis, and they're looking, to get like it or not, a little bit further out for a little bit more room, which is what everyone needed when we were working and learning remotely. So incomes are still rising. In fact, I think income growth will have a pretty good year, but it's mostly because of inflation, right? That workers were demanding kind of higher compensation to keep their cost of living, to keep their purchasing power flat. And also businesses obviously struggle finding labor, in this tight labor market still. And so they want to retain those employees. So, sure enough, guys, we're still spending about 25.5% of that pre-tax income on the mortgage. So 25.4, well, that is ahead of 24.8, but not by that much, really, right? I call those on either side of 25%. I mean, they're not even 1% off, right? One is 2/10 below, one is 4/10 above that quarter, right? Quarter of our pre-tax income on housing. You look at LA, the Bay Area, different parts of the coast, 50% of the median income. How about a price to income ratio? So what that was what percent. This is what's the ratio of home prices to our incomes? Well, we used to spend about 3 times our income. So let's say you're making 100K, your family's making 100K, 2 earners each making 50, really common for a region. So 100K, but they got to go buy a $300,000 house. They had to go spend 3 times their income. 3 times their 100,000 income equals the $300,000 house. So we kind of got back to, 3, now 3.2, and now 3.3. So about 3 1/3, we spend 3 1/3 times our income on housing. It's 3.3 versus, 3. It's up, but I wouldn't call it a world apart. I wouldn't call it, light years away. It has risen. It is, at fresh highs. But, again, I think if someone saw 3 back here, they would think, well, we must be at 5 or 6 now. No, just 3.3. Interesting. A new one. Well, not new, but I haven't been using this one and I want to bring it back. All right, quickly. I said we had to keep moving. Let's keep moving. So payment in blue over to the left, price in red corresponding with our axis off to the right. So price is 230 down to 150, prices up to 365. Payments 1,600 down to 900, back up to about 1,600, and all of a sudden $2,300 a month spent on the mortgage payment of the median priced home, assuming 10% down and so on and so forth. So not 20, but not 3.5 or whatever for say FHA. So I like this. Look at payments. Payments appear to be even above prices here. Obviously they're not. 230K is well ahead of 1,600, but just bear with me. Look at how close payments and prices were. And then what happened? They detethered, right? They diverged. And what's driving that? Low rates, right? So even though, prices really started to rise, look, payments were flat. So here, look, we had a median price of 280, or call it 280. Well, that's well ahead of our 230 previous peak, but our payments were actually below. How is that possible? 1,600 versus 16.25. Easy interest rates, right? So declining rates declining rates can offset rising prices to keep payments flat, right? So that's a key, but look at what we see now. Used to be this nice gap. Now we really see this convergence again, where payments are getting much closer to this price trend line. You can't say payments are getting closer to price, although I suppose they are kind of, but just look at this gap, right? Now, this kind of inverted. Again, take it with a salt shaker, work with me, guys. But here, blue is above red. Blue's been below red for a long time, but it looks like we're flirting again. We're just kind of smooching, and let's see what happens, right? Let's see what happens. All right, I'm excited to share, and I do have to hurry. I'm excited to share some preliminary visuals using a new process, and we're trying to capture delisting activity. Again, preliminary, still kind of under construction. Number delisted, you know what? Well, number delisted. It looks high, not quite as high as that. But remember, inventory is still lower than this. So it's a higher share. Even though it looks like the same number, it's a higher share. So rolling 12, kind of looking at that delisting rate, I didn't have to delist my home in 2020 and 21 and most of 22 because it was selling almost immediately, right? And then we see, you know, a little bit of a kind of a comeback to where we were. How about the delist rate? We actually captured 25% delisted of whatever didn't sell at month end was kind of delisted. That's pretty close to 06 kind of peak bubble or right after peak bubble levels. Let's use our rolling 12-month average. Similarly, look at the delist rate. 16% came way down, right? Kind of in that 12 to 13% range. That was average for a while. And now look, we touched over 17%. Listen, I don't have to sell my home if I don't want to. I don't like the offers I'm getting, right? I don't want to accept less. And I don't have to. So I'm just gonna delist it and try again in a few months or see what happens, or remodel or whatever. So pretty interesting there. I shouldn't say similarly, but another note here, a disappearing act percentage of actives under 250,000 using our rolling 12. Got a recession here. Oops, I should really put in that very brief recession in 2020 there. I'll work on that. We've got the Metro in gray, Minneapolis in blue, and St. Paul in red. St. Paul, 86% used to be under 250, now 45%. Minneapolis used to be 74%, now down to more like a third. Have been some changes though on the Minneapolis side. And then metro-wide, all the way down to 15%. Used to be 70%. So maybe that's not fair, guys, because that was kind of into the crash. And this is kind of peak of the bubble where we also didn't have that many. So, maybe kind of average that out to 55, versus 15. So really big changes there. All right, interesting thought, shifting gears. Zoom towns could be in trouble. We talked about how local incomes and population dynamics really are the big determinant of how much people can afford. So people brought their high incomes from the coasts to places like Austin, Boise, Raleigh, and where else? Not Salt Lake or Denver, Charleston, maybe, I don't know, maybe Charlotte. But when they leave, will the region be able to sustain the current pricing? This is the question. Locally, we really haven't experienced that at all. So how deep is the mud, you guys? Well, it depends on who we ask. Ever since I went to the vet, everything has been loud as heck. Case Shiller, USA, blue. Here's Minneapolis in pink here. I threw in Denver, Vegas, Phoenix, Seattle, Dallas in green. You know what, guys? Let's just do it. Let's do it. Let's look. Let's make it interactive. This will be good. I think you guys will get a kick out of this. Well, I also want you to be aware that it's available. It's a thing that you can do. All right, so here it is, Real Estate Decoded. Let me zoom down, and I really want to show you this one because I think it's the most interesting one. Okay. Home price appreciation over the last 12-month period. All right, so we've got everything selected, guys. Every one of these metros. Let's go Minneapolis here. Now we can kind of see our beautiful city. We can tease out Seattle, right? Back to Minneapolis, Detroit. We can shut these off. And maybe I just want to turn on the nation and us. Interesting. How about us and our friends in the Bay Area? Interesting. Man, they were rocking and rolling way ahead of us, right? 22%, 24% year over year price growth, while we were barely 14 and 12. 24. They're down now, right? So the higher they climbed, the harder they fell. What else, guys? Let's look at Seattle. Identical story, isn't it? 25% and 28%. And look, they're below us now. Stability, predictability, and consistency are good things, right? It's more sustainable. It's less volatile. People get less, they're not as uneasy about, what's happening with value. So, I think this is pretty clear. Let's throw in a Phoenix. I haven't quite looked at that. Phoenix plus 33%. That's a $300,000 home this year selling for $400,000 next. They were plus 33% while we weren't even half that at 14. But look at them now, 5 and 6. 5 and 6%, guys. You can't make this up. So these places that went bonkers are now divergence, reconvergence. They're just sinking right back up with us. And let me just turn on all real quick. And, look at the average. Okay, there's some wonky ones. Goodbye, Seattle. Who's our light blue here? Oops. I meant goodbye, Seattle. And who's this? Goodbye, Vegas. You didn't have good luck this time, Vegas. San Francisco, let's get rid of the San Fran folks. Okay, just sort of simplifies things. Guys, look, 3% on the low end, 8% on the high end, right? 4 to 7, 3 to 8%, that's common. That's historically average. Where are we coming right back into? Right back into that historical average. But people are conditioned by this, right? They've been impacted by this, and their expectations have been adjusted and conditioned or skewed by this. So I think we're in a better place, even though we didn't quite see the boom that some other places did. Interesting stuff. Anyway, okay. Let's keep trucking. Oh God, running short on time. Home price forecast, guys, for 23. So latest forecast from different entities. You guys can see how Realtor.com versus NAR and the Freddie and Fannie and the mortgage bankers look. They're thinking pretty flat. Plus a tenth, right? Plus a tenth. Now, that's national. That means that includes Los Angeles and Manhattan, and also Lincoln, Nebraska, and Montgomery, Alabama, right? So, or maybe Baton Rouge would be a better, I don't know. So this is really everything. Rates, really quick touch on them, guys. The latest figure, at least national, was about 6.12. I'm hearing more 6.25 and even 6.3. Who remembers when rates were 18%? All right. I don't personally remember. I was just coming into the world around that time in the early mid 80s. But look at the trend since. And let's zoom in more recently. So now let's only go back to 04. So interesting, in 06, remember, rates almost touched 7%. I think we were 5.57 or, excuse me, 6.75 or so, almost 6.8, not quite 7%. And sure enough, we just kissed 7%. Now back down to, 6 and change. Again, I think people will be encouraged if they see 5.5, especially if they see 4.99. I think people will be coming out of the woodwork. That's my thinking. That's what I think. All right, as rates have risen and the market's still down, is now a better time to deploy our cash? Probably, right? If your money was earning you 10 or 12% in the stock market and you can borrow at 3 or 4%, shouldn't you? But now if it's going to cost you 6 or 7% to borrow and you're not sure your capital can appreciate at a greater than 7% annualized rate, well, maybe it is a good time to deploy that cash into the market and not pay interest. So 15% of all sales were done entirely in cash. It's probably more than most think. I would bet. I would bet most people. Oops, lost my laser. I would bet most people are probably think we're down here. 3, 4, 5, 6%. 15. That is the highest level in almost 10 years. What, 8, 9 years since 17%. So pretty interesting. Affordability, yeah, higher levels, better affordability. Lower levels signify deteriorating or lower affordability. So peak of the bubble, right, affordability relatively low. After the crash, affordability better, kind of stabilized and flattened out a bit. And then what was causing affordability to come down in 2021? Prices. What was causing affordability to come down in 2022? Rates on those prices. Projections, a little bit of a rate projection here. So again, the four entities focus on the average. So far Q1, yeah, they're spot on, 6.25, 6.35, just about right. By second quarter, so as we're getting into sort of spring market, they're thinking more like 6 flat. As we get into the more July, August period, they're thinking more like 5.9. And then as we get into October, into the fall and winter this year, they're thinking more like 5.5, 5.75. So no one's forecasting 4.9 this year. Well, no, yeah, no one is. 5.2 there. MBA, mortgage bankers feeling a little more optimistic, which is interesting because usually they're not. They're actually usually a little more bearish. I love this one. We might have to wrap on this one, guys. Housing costs are locked in. Actually, maybe I have one or two more. Your housing costs are pretty locked in. At least the first principal and interest are. Taxes and insurance move a little bit. Not as much as I think people like to say that they do. So anyway, look, here's your monthly salary. Here's your mortgage payment on a $350,000 loan at 7% interest. Now, this payment is taking up 35% of this salary. However, in 5, 6, 7 years, your payment will be pretty flat, but your earnings won't be. Your earnings aren't anchored or tethered in that way, right? So the world is your oyster. Sky's the limit. And as you continue to experience income growth, look, that mortgage payment's gone from 1/3 down to 1/4 of your earnings. So, it seems like a lot now, understood and agreed and definitely heard, but give it a few years, right? Give it a few years. All right. Had I asked my customers what they wanted in 1903, they would have told me they wanted a faster horse. The reality is, here's the technology that we always needed. Just which is the short side of the sheet and what's the long side of the sheet. In the 90s, I love this story. In the 1990s, Tide thought people cared about brighter brights and whiter whites. They didn't care about that. Maybe a little, not really though. Most people, it turns out, I bet you can agree, most people just didn't want to smell bad. And they're less concerned about the brilliance or intensity of their shirt colors. So I just find this such a cool story. Tide completely, they really turned the tide. They completely changed their advertising to freshness that lasts or something like that. So even some of the best brands and companies in the world can be clueless to what their customers want and need. So always be learning, then adapt, then implement. It is never too late to learn more about your business, more about your industry. It is never too late to learn more about your clients, to learn a new skill or what have you. So I really do encourage you guys to kind of think about that. All right, last two, guys. How will this benefit you? Listing presentations, opens, showings. You're doing more prospecting. You're thinking about lead gen and lead capture. How about personal marketing? I always love this one. I love to give the example. How do I use the data to market myself? Easy. Average days on market in Edina is 58. My days on market is 26. I can prove it. Here's the data. This is why you should list with me, right? So leverage it in that way. Here's a good one, managing expectations by making sure your clients are in tune with market realities, right? So again, managing those expectations. Guys, perfect example, inventory up 15%. Oh, now we can lowball everything, right? Well, let's pull those expectations back just a little bit. Better decision-making, more ease with forecasting and business planning. And how about identifying growth opportunities? We didn't talk much luxury today and probably obviously won't have time, but luxury, a growth segment, right? Resorts, lakes area, cabin areas, probably more of a growth segment, maybe slowing down a little bit in the somewhat post-COVID era, but just a couple things to think about. At the end of the day, we can't control the wind, but we can adjust our sails. In an ocean of possibilities, it's think or swim. With that, I will call it quits, say thank you, and check chat for any questions. Oh, Christine, definition of delist. Let me talk offline about that. We're still working through that a little bit. Think of it this way, though. What was newly listed last month minus what went under contract there should be some spillover that carry into the next month. And if there's not that spillover, it stands to reason that they were delisted if they didn't go under contract. It's not perfect. We're still working on it. It's still early. That's why it's preliminary. But we're doing new things. We're reacting to kind of what has been happening, and we're really trying to keep you guys informed and up to date with what's going on in this changing market. As you guys know, shift happens, right? Shift happens. So we are experiencing a little bit of a shift. Sarah, anytime, thank you. Holmers Group, thanks so much for joining us. Please do use this stuff. Nan, so good to have you here and so good chatting with you a couple weeks ago, I think. Heidi, absolutely, you will be sent a copy of the slides. And Christine, always good to be with you, and really just appreciate all the enthusiasm. I do want to shout out to Nan and Christine in particular, being data-minded folks who really are interested and care about this stuff. And I know it's helping your business. So as I say, use the data for good and never for evil. And please do check back next time for our next webinar, third Thursday. You guys all know this. They are free, but you do have to register. So tell your friends, tell your colleagues, please do come and enjoy learning about some stats next time. Thank you guys. I'll let you go. Thanks for sticking a few minutes over with me. Really appreciate it, and have a wonderful day.